Some of the craziest financial history ever was made recently. In addition to turning around the fortunes of a video game retailer, GameStop, a group of ragtag millennial investors reshaped the financial markets and reset the balance of power between Wall Street and Main Street. This is how the story began. On one side, there were veterans of Wall Street's short-selling market who had concluded that GameStop was on its knees and could smell money could be made by wagering the company would fail. On the other side, a battalion of rogue investors online that made trading on the stock exchanges simpler than ever, who gathered together on the prominent website Reddit to plot their attack on the financial markets and, in some instances, make big money while sticking it to the man. How exactly could a failing game business that started 2021 with a share price of $17 trade for $483 just 3 weeks later? Who were these young men instrumental in taking GameStop to new heights, and what motivated them to do so? Why did regular investors risk so much money on a stock that promptly crashed, causing most to lose everything? Our story begins with a dedicated group of traders on the subreddit r/WallStreetBets, a space for market news aggregation and discussion. It was in this forum where anonymous retail investors worked together to make stock prices explode. On other subreddits, investors are encouraged to make money like a boomer dad, but WallStreetBets was different. It's where all the craziest Wolf of Wall Street dreams come to life. These guys aren't interested in making annual returns of 10%, they're motivated only by a desire to rapidly accumulate wealth. The ingenious plan began getting cooked up when a user complained that GameStop was priced too low. The concept that r/WallStreetBets would take over GameStop started out as a joke, but it soon took on a more serious tone. The plan was for the small guys to beat up on Wall Street and punish short sellers. Short selling is a common technique to make money off failing enterprises. In this strategy, shares are borrowed for a fee, sold at a high price, and then repurchased at a reduced price. If the business goes bankrupt and you don't have to return the shares, then you win big. The problem with short selling, however, is that if the stock price rises, the seller loses money, and if it continues to rise, the losses might be limitless. There are a number of additional possible negative outcomes, such as an increase in fees or the original investor demanding return of their shares. As a result, some short sellers will be obliged to cover or buy back their shares of stock at a much higher price than they originally sold them. Wall Street was filled with investors willing to wager against GameStop's success than on it. A few online observers mused that the stock was perfect for a short squeeze. Simply said, with so many people short, it's possible to set off a domino effect by buying enough stock to drive up the price, causing some shorts to cover, which in turn drives up the price even higher, causing even more shorts to cover, and so on and so forth. Apps like Robinhood make this process simpler and cheaper for individual investors. Option purchases for stocks are as simple as buying the stocks themselves, and may be made in the same places where stock trades take place. If you think a company will go up in value, you could put your money into it by purchasing a call option, which entitles you to purchase the shares at a certain price by a predetermined date. So, a fictitious investment company wants to purchase a call option from you. Shares of Company X are $10 right now. Since you have faith in Company X, you have decided to invest in call options that will allow me to purchase 100 shares of Company X stock on March the 1st at $25 per share. In most cases, this contract offers savings above the share price. Let's imagine that on February 14th, shares of Company X had risen to $50 after having started the month at $2. If you decide to sell your options, you'll get a profit. You might either sell them now at a price of $55 each, or you can wait until, say, March 14th to take possession of the 100 shares and sell them. Thus, you net $30 per share after paying the options costs. But like other securities, including stocks, bonds, and mutual funds, options carry no guarantees. It's possible to lose the entire principal invested, and sometimes more. As an options holder, you risk the entire amount of the premium you pay. Now obviously, you must have a counterparty in the exchange. The company that sold you the options plans to acquire shares in Company X in an effort to mitigate the potential loss from your options. The higher the stock price rises, the more shares of stock your counterparty will have to purchase. In the past, trading options was considered to be a complex activity, beyond the scope of most average investors. Options trading is made simple and cost-free by Robinhood. Furthermore, our Wall Street Bets caters to the social side of trading. Trading stocks has become a social status symbol. Wall Street Bets pounced when professional short sellers who triggered the prospect of a short squeeze failed to account for the expertise of day traders. It's time to scam Wall Street out of a pile of cash. The good folks at Wall Street Bets thought GameStop was undervalued, so they posted a series of links to articles about how they were purchasing GameStop options in anticipation of the stock's rise. Due to this, GameStop's stock price rose, as its counterparties had to buy more stock to maintain a balance, and then more shares as more investors purchased options. Some short sellers were forced to buy as a result of the stock's meteoric rise. These hedge funds had to eat losses of over $5 billion from their GameStop holdings alone. Where does Robinhood fit into this scenario? Robinhood seemed like a great gift to everyday investors, since it lowers the barrier to entry into the options market. But there's more. When using Robinhood, you can make trades without paying any commission. But Robinhood isn't giving out free trades out of the goodness of its heart. It's really being paid by institutional investors like Citadel Securities to monitor the behavior of regular investors. Payment for order flow describes this practice, which is common among brokers. With these orders, Citadel Securities may automatically take the opposing side of the transaction, then return to the market to flip the trade, therefore generating a profit. According to the Financial Times, it pockets the spread, or the difference between the purchase and sell prices. Front-running orders means buying an asset before a client does so, in the hopes of realizing a tiny profit if the share price rises. According to the SEC, there is no evidence that Citadel Securities participates in such activities. However, the SEC charged Robinhood with misleading representations and omissions for hiding the fact that it gained money from its traders by selling their orders to third-party companies. The SEC claims that Robinhood customers lost a total of $34.1 million due to subpar pricing. Now you might be asking whether what are Wall Street Bets, a group of investors conspiring to manipulate stock prices, is doing is really illegal, given that they have made enormous profits and screwed over some powerful hedge funds. And the reply is, maybe? Although it seems like a pump and dump operation, everyone involved is telling the truth. In theory, the SEC could track down the Wall Street Bets investors, given that no one is truly anonymous online. However, this sounds like a lot of work for what is not actually a watertight case. The situation would be an enforcement nightmare. So, the Wall Street Bets guys cracked the code, right? By working together, they could beat Wall Street insiders at their own game. Well, yes and no. Although the meme revolution popularized trading, it made it more difficult to identify winning investments from losers. Investments praised on online discussion boards like Wall Street Bets rose in price because day traders predicted they would, regardless of the true worth of the underlying asset. Day trading has been fashionable before, and its practitioners have frequently been unfairly criticized for their perceived lack of caution. For example, after the GameStop craze was over, some of these inexperienced investors rushed into the insolvent rental car company Hertz, despite the fact that the company had little chance of recovery. Many Wall Street Bets investors approach trading as if it were a game. If they lose it all, that's alright, because they can always hit reset and keep playing. Except the money these Redditors YOLO'd away could have been used to pay off credit card debt, saved for a home purchase, or just being put to work in a productive asset, rather than a shot-in-the-dark short squeeze. That being said, it's hard to root against the Wall Street Bets guys, because plenty of hedge funds, short sellers, billionaires, and institutional investors treat investing like a game too. And every once in a while, they're bound to lose too. And even the lucky underdogs can turn in their McDonald's work uniform, hop into a new Ferrari, and drive off into the sunset, free at last. The GameStop tale is a typical illustration of speculative investing motivated by hype and FOMO. In this instance, fear of missing out on easy and fast money. One key takeaway from the GameStop roller coaster is undoubtedly this: if the buzz around guaranteed high profits attracts you to an investment, consider the potential downsides. And secondly, smart investors spread their risks by diversifying. It's essential to keep in mind that only seasoned investors who are fully aware of the dangers associated in the quest for bigger potential returns are suitable for using these and other speculative techniques. These dangers include the genuine possibility of losing part or all of your invested funds. By spreading your investments among several assets that don't all rise or fall at the same time, you can reduce your total risks rather than depending on the success of any one investment. Were you part of any Wall Street Bets short squeezes or know someone who was? We'd love to hear about your experience. Please leave your story or opinions below in the comments. So, subscribe to Ape Finance, and we will see you in the next video.